Hello and welcome to this ERI Scientific Beta webinar. Our speaker today is Felix Goltz, Research Director with Scientific Beta, and today we're going to focus on common misconceptions about smart beta. As always, we have some materials for you to follow, which will help outline the key points discussed, and we will be taking questions from our audience. So if you have something to ask us, please do so via your webinar interface, and we will try to get your questions to Felix before the end of today's session. Okay, Felix, thanks for being with us today. Let's begin. So we know that in investment management, smart beta has become increasingly popular in recent years, and there's often been a lot of debate about the benefits of these strategies, as well as some criticisms. And it seems this is where some misconceptions arise. So can you start off by telling us why exactly there are misconceptions about smart beta?
Yeah, sure. So this debate that you mentioned has actually resulted in misconceptions, I think, because there are actually there's a lot of confusion. And there's lots of different angles to this debate. So a first aspect is that, well, smart beta actually draws very severe criticism, but from two very different sides. So on the one hand, you have providers of traditional active management, and they criticize smart beta in a nutshell sometimes for not being active enough. And on the other hand, you have providers of passive management who also criticize smart beta, and from the standpoint of, when you do passive management, you shouldn't move away from cap-weighted indices. So there's a very different angle. And, in a nutshell, it's more, the criticism is more, well, it's not really passive enough, these smart beta strategies. So that creates some confusion that you have, criticism from these two different angles. Mm-hmm. But even if you look at smart beta providers, you could think that smart beta providers, they are in this approach of providing something in between active and passive management, and they would somehow agree with each other and respond to that criticism, but actually that's not the case. So the smart beta providers do not agree with that other at all. There's lots of debates between smart beta providers on really what are even the defining characteristics of smart beta, and there's no agreement. And so that kind of disagreement again creates actually a lot of confusion. Arguments, and we'll discuss that in detail, are not always based on facts, and so there are misconceptions that arise really as a consequence of that debate.
Okay, so you've given us some of the reasons why there are misconceptions, but can you detail some of these misconceptions? What are they exactly?
Sure, so there's a large number of misconceptions.
Of course.
And we actually looked at the 10 kind of most common misconceptions. Okay. So we looked at all the debate and some of the misconceptions that have arisen, and we basically selected 10 misconceptions that are probably the most widely held misconceptions. And also these 10 misconceptions are clearly on issues where we think that relying on these misconceptions actually leads to risks for investors and may actually misguide them in making investment decisions. And so in this presentation, we're not going to look at all 10 misconceptions. We actually just completed a paper on these 10 misconceptions and where all of these are dealt with in detail. But here we're just going to look at a selection of these misconceptions. Now, these 10 misconceptions, they really arise in three different areas that are very important for investors. So the first one is really on what are the sources of smart beta performance? Where does smart beta performance come from? So this is an important question, and again, there's lots of disagreement on this. A second issue is on the investability of smart beta. So is it really possible to actually reap these benefits of these strategies in kind of a real-world context, and what are the challenges of actually investing into these strategies? So this is another important area. And finally, an area which really goes into the detail of how these strategies are constructed is really, well, how do you make sound index design choices? And again, there's a couple of misconceptions in the area, in this area. So how do you actually design smart beta indices? What are kind of sound principles of index design? So in this presentation, we're not going to look at all 10. We'll just focus on 5 of these. And so they're shown here. So we'll start discussing the monkey portfolio claim. We'll look at the crowding hypothesis, and then we'll look at several questions in index design.
Okay, so well, let's begin with the monkey portfolio claim, like as you just mentioned. We've talked about this before. Essentially, some of the proponents of this claim say that randomly selected strategies can essentially outperform a cap-weighted index, and smart beta strategies might be similar. And it's even been purported that smart beta strategies can be turned upside down, completely inversed, and still outperform. But what's your view on this?
Yeah, so there's a very strong argument by these monkey portfolio proponents. So the key argument, if you will, if you really break down the different arguments, the key argument is really that these strategies are kind of so random that even when you invert them, nothing undesirable happens. So actually, if you invert a strategy, it's actually going to deliver better outperformance. So we have this citation here. So this is referred to as the monkey portfolio claim, because the idea behind it is basically that the investment philosophy really doesn't matter. The index design doesn't matter. Even if you take the inverse of the strategy, it will still outperform. And taking the inverse is clearly something very random. So if a strategy outperforms, but the inverted strategy also outperforms, I mean, clearly that would mean that the real investment philosophy and the index design, clearly are not crucial for that for that performance. So these claims seem to be very strong claims, and so what we did is actually we tested them. So we ran an analysis to look at what actually happens when you turn strategies upside down. And kind of there's an important consideration on the results that you would expect. So think about the behavior of an inverse strategy. If a strategy is somewhat similar to equal weighting, well, you would actually expect that inverting it is not going to change anything, right? So if your strategy is very close to equal weighting, you invert it, it'll still be close to equal weighting. And so you don't expect to get any big difference between these two strategies in terms of the performance. And we will actually see that this argument of monkey portfolio proponents really relies on this kind of biased selection of the strategies. So if you select certain types of strategies, you may be able to show that for some strategies, the inverse behaves somewhat similar to the original. What we try to do is really apply this analysis to a broader set of strategies. And so we look at popular strategies that tilt towards factors and that use different types of weighting schemes. And this means that our results are going to be different because we actually select different types of strategies. But if you think about the monkey portfolio claim, the monkey portfolio claim has really been made in a very general way. So there aren't any strong disclaimers that these conclusions only apply to a certain specific selection of strategies, but the claims are basically put out and made in a very general fashion. So if they hold in this general fashion, then we should confirm them even with our selection of strategies. So let's look at these results that we get. Well, what we actually do is we turn strategies upside down. So we're going to invert the stock selection and the weighting to a number of strategies. Here I'm just looking at specific results on 6 factor tilted strategies. So we look at a size tilt, momentum tilt, a low vol tilt, a value tilt, and then tilts to profitability and investment factors. The strategies are all designed by a simple stock selection and then tilting the stocks basically again through the weighting scheme to that same factor. What you can see is that there is a big difference between the upside down strategies and the original strategies. So if you look in terms of returns in excess of the cap weighted index, well, all the original strategies outperform, and all the upside down strategies of the factor tilted approaches actually underperform the cap weighted index. If you want to have a kind of a strong result, for example, you can look at the low volatility tilted strategy. Well, the return of the inverse strategy is lower and the volatility is much higher. So volatility goes from about 15% in the original to about 26% in the inverse. So clearly the inverse does not deliver even better performance. It actually delivers much worse performance on a risk-adjusted basis and also in terms of returns. And so you can see that clearly this monkey claim doesn't apply. Now, is this surprising? Well, obviously it's not surprising. It's not at all surprising that when you invert a strategy that delivers performance, the inverse is going to deliver underperformance. But since these claims had been out there, we thought it's worth actually testing this empirically. And we apply very similar methodology of inverting these strategies to the original papers in this area. And so it's not surprising that we actually come up with these findings that clearly don't validate the claim. But what's interesting also is that just looking at the literature, you're really not surprised by these findings. So our findings are fully consistent with the academic evidence on factor tilts in particular, because all the papers on factor tilts, they actually show that tilting towards the factor delivers higher returns, but tilting away from the factor also delivers lower returns. So these results in our study are kind of a direct test using the upside-down methodology that was used for the monkey portfolio claims. But actually, our findings are not surprising, because just looking at the literature, you would expect that inverting doesn't lead to the same performance.
Okay, so you've tested these in a detailed fashion, and I guess you can say that smart beta is not monkey business, which incidentally is one of the names of our white papers on the topic. So we invite our viewers to consult that. Now, moving on to another misconception, one which is often brought up is the one about crowding. And there's this belief that the benefits of a strategy will disappear the more it becomes, the more popular it becomes. What can you say about this?
Yeah, so this is an important point in the current discussion. Mm-hmm. I just have an illustration here of the kind of claims that you find. So, I have a citation here on this slide. So, where it's basically argued that, well, smart beta strategies have becoming increasingly popular. So then it also makes sense that they should be increasingly overcrowded, which could result in factor crashes. Okay, so this is kind of the typical statements on this topic that you see. But really, if you look at these kind of statements, you can see that this is basically a completely unfounded assertion. So, things are not well defined. So, you can talk about overcrowding, but if you don't define what overcrowding means, then, you don't actually know what precisely this claim is about. If you make statements like something could result in crashes, I mean, yes, obviously, there could always be a risk of crashes. But frankly, we don't really know precisely what exactly is it that you're claiming. And in particular, what you would like to do is you would like to have a kind of definition of what you mean by crowding and a way of actually testing for it. So if you look at especially the very popular strategies by some major smart beta providers, they have gathered sometimes tens of billions in assets under management. So if there is crowding, there should be some evidence that this crowding has occurred, right? We know the different indices, we can analyze the constituents, and so if someone makes a claim of crowding, he or she should provide some evidence that crowding is actually there. Now, there is actually an important question in all of the literature on this topic of factors in particular, which addresses the issue of persistence. Okay, so if you ask the question, well, if something is known to everyone and is well documented as a factor and to deliver higher returns, should that factor, should these premia, should they actually persist? Okay, this is a question that has been widely documented. What is the persistence of these premia? And here you can look at this from an economic perspective. So the literature has actually come up with explanations for why they should or should not be persistent from an economic perspective of these different factor premia. And kind of a key insight is that if these premia, they are risk premia, so they are a reward for taking on additional types of risk, well, then there's actually no reason that they should disappear. Okay, these should be persistent because investors may tilt towards these factors to gain higher returns, but obviously some investors, because of the associated risk, will actually shy away from that. And there are actually a large number of risk-based explanations, and there's formal theories that show that these stocks belonging to these factor tilts are actually more risky, and in that sense, there should be persistence in performance. So for all of these 6 factors, for example, that we addressed previously, there are risk-based explanations. Another type of consideration about persistence is, well, what if these strategies don't expose investors really to additional types of risk, but they are purely behavioral? Okay, so there's just some biases, investors are irrational, and so they make some errors, and some stocks may be overpriced and others may be underpriced. And you can identify these errors and you can act on them. Well, then in principle, these premia should disappear unless there are what is called limits to arbitrage. So if rational arbitrageurs cannot actually act upon the insights because there are short sales constraints, for example, and the other types of, if you will, institutional constraints that mean that arbitrage cannot be carried out effectively. So if there are kind of risk-based explanations, if these factors expose investors to additional type of risk, they should persist. If they are purely behavioral with no limits of arbitrage, they should disappear. And if there are limits of arbitrage, then they can persist. And so this is a kind of a well established finding in the literature. Another way of looking at this is not so much from an economic perspective, but purely from a statistical perspective. And again, people have looked at this question of persistence from a statistical perspective. So I'm summarizing some results here. There's a recent paper in the Journal of Finance by McLean and Pontiff, where they actually look at a host of different factors that have been documented in academic research, and they ask an interesting question. They basically ask that, well, when these premia become known, when they become published, well, do they actually behave differently afterwards? So do they actually disappear after they are published? So they call this the post-publication premia. They run formal statistical tests, and they actually reject the hypothesis that post-publication, these factor premia disappear. Okay, so there's a formal test basically providing evidence that these premia do not disappear. What they show is also that a reduction of these premia occurs, so there's somewhat a reduction in the magnitude of these premia, but they reject the hypothesis that they actually disappear. Now, this is an extensive study on almost 100 factors, so it's interesting also just as an illustration to look at maybe the most well-known factors, and here I draw on an illustration by Asnas, who published this table. And he just looks at a very restricted set of very consensual factors. So these are basically the factors in the Carhart model. And what you can see is, well, if you look at size, value, and momentum, well, the premium is actually still there after publication. Okay, so what you see in the table is results for different periods. So the period in the middle, 1963 to 1991, corresponds to the period that was used to actually document these effects in famous papers on factor models in the early 1990s. So this is the data that was available then. In this data, the effects were shown to be there. And then what basically you see in the table is a second analysis looking at the premia from then, from the early 90s, to 2015. And you can see that the premia, they're still all positive. They're actually relatively similar in magnitude. Mm-hmm. Okay, so if you look at the size premia, it was 3.2%. After publication, it was 2.6%. Somewhat similar results for value. And so you do obviously have a difference. You will always have differences between two types of data sets. But the statistical test also tells us that this difference after publication and before publication is actually not significant. So the t-statistics are all far below 2 in terms of magnitude. So there's really no evidence that these factor premia have disappeared either.
Okay, but despite what you're saying about crowding and there's no evidence that these factor premia have disappeared, we still hear all these warnings in the press that smart beta can go horribly wrong because of overpriced factors. As you mentioned, overcrowding might lead to factor crashes. Is there any basis for such claims at all? Or are they just sensationalism, perhaps, from the media?
Yes, I think it's interesting to look at these claims, and in principle, what you can see is that this is widely covered by the press, and it makes kind of headlines that correspond to warnings using kind of very strong language. Mm-hmm. So the vocabulary used is very attention-seeking. There's smart beta crash and it'll wreak havoc and everything is overpriced. So this is clearly attention-grabbing language. Now, attention-grabbing language is one thing, but making a kind of founded statement is something entirely different. And so really the question, I think, is that, okay, we've seen now these headlines and this attention-grabbing language, and that apparently seems to work to kind of get statements into the press. The question is, well, okay, so what is actually is there any evidence, is there any foundation actually, are they basically just unfounded assertions? And what you can see is, well, you can basically look at the empirical literature and you just take even a brief look at empirical asset pricing and see whether there's any contradiction with these kind of claims. And I mean, basically you see that these claims are clearly in very stark contradiction with kind of the consensual findings that we have in the empirical asset pricing literature. So, I mean, let me just go through this just to explain this. Kind of a first claim, which is very, I think idiosyncratic in this argument, is to say that, well, these factors, they don't really exist. Actually, it's just that stocks have always become more and more expensive in the ones that correspond to these factors. And so, these things just became more and more overpriced. Investors are chasing performance, and so these things don't really exist, actually. It's just that, they're not real effects. There's nothing structural. It's just that things have become overpriced. So if you look at this claim and then you contrast this with empirical evidence, I mean, you can only be puzzled because, the empirical evidence on these factors is not that there's one paper based on one sample that has provided evidence on these factors. So if you look at the consensual factors, like the couple of factors we've been discussing so far, there's very extensive evidence. The studies have been replicated independently. A typical study on US data, for example, typically looks at close to a century of data. So do we really think that a factor that has been documented on about 90 years of data is just due to stocks becoming always more expensive over these 90 years? That doesn't seem like a reasonable claim. These factors have also been documented in other types of data sets, different countries by different researchers, criticizing each other. And there are even economic explanations for them. So, of course you can go out there and say that, well, this is all just because stocks have always become more and more expensive. But, there's really no evidence for that. And just looking at the academic evidence, is just completely in contrast with this kind of statement. Another statement also is that basically, since these factors, they don't really exist, it's just stuff that has become more overpriced. You should basically time this, right? You shouldn't have static exposure to these factors. You should just time them based on how expensive they are. And again, if you look at the empirical asset pricing literature, so there's surely a lot of studies on predictability. But overall, if you look at the results, the empirical literature is quite agnostic about capacity to predict. So of course, given a data sample and hindsight that you have, you can always find predictability. But in terms of kind of real life predictability, so out of sample predictability, I think the literature overall is quite agnostic on possibilities to make successful predictions out of sample. And so making a claim that you can predict reliably these factors, and you can do so with a very kind of simple valuation metric, is just a highly unusual claim if you look at the overall picture in the literature. So in the end, when you look at the kind of press coverage on this, I think you can post headlines saying that smart beta could go horribly wrong, but I think what is in fact horribly wrong is when you discuss these matters by actually ignoring the peer-reviewed academic evidence. There's lots of peer-reviewed academic evidence there, so I think we should use it and look at it.
Okay, so as you say, it's important to look at peer-reviewed academic evidence, the consensus over long-term periods of data. For example, we have century-old data, and we shouldn't pay too much attention to sort of one-off results or outlier results. Okay, now moving on, let's look at factor fishing. And now a lot of providers have created lots of enhanced factor definitions. Everyone has their own definition of the value factor, for example. Now, do you think these enhancements are well conceived, or actually you argue that they're ill conceived? Well, why is that?
Yep, so these enhancements are very popular, and especially product providers always try to come up with an enhanced definition of a factor rather than using the standard factors. But actually these enhancements, they carry very important risks. So if you go to these very consensual factors, they've been around in the literature for a long time, as we discussed, and they are fairly reliable. Okay, so these results are quite reliable for a number of reasons. If now you look at some tweaked versions of these factors, or some trendy proprietary factors using somewhat different scoring criteria, using some tweaks maybe on top of the consensual factors, well then what can you say about these tweaks? Well, they will improve the backtest, of course. I don't see how these tweaks will lead to worse backtests. If they do, that backtest will probably never be published. So they of course improve backtests, but there's really no reason to think that they will also reliably improve performance outside the backtest. And I just tried in the table here to contrast these two approaches, so staying with the consensual factors or actually using enhanced factors. And let me just try to explain why these consensual factors are just much more reliable than enhanced factors. So the first reason, and this is really the most important reason, is probably that they have very parsimonious definitions. So if you look at a simple momentum factor definition, okay, it's just based on the past short-term returns. There's no further tweaks or adjustments, for other kind of risk parameters or these kind of adjustments. So it's very simple. There's not a lot of parameters that go into this variable definition. And what that means is basically that you're actually explaining this return pattern, this momentum pattern, actually with relatively little information and little parameters. So you have very little room to actually overfit the data. If now you move to an enhanced version of the momentum factor, Well, once you open the door to enhancements, you can test an almost infinite number of variations if you make all sorts of adjustments, for example. And that could lead to overfitting. Okay, so you can come up with a very complex definition that nicely fits the properties of the sample and leads to nice performance, but there's really no reason to think that it'll actually continue outside the backtest. Another key important issue with consensual factors is, well, the consensual factors have kind of survived an intense process of analysis and external scrutiny. Okay, so as we mentioned, these factors have been around for a long time. There's hundreds of papers on the key factors. A lot of these papers are critical, so different researchers kind of try to come up with tests of robustness of the initial results, and yet these factors actually have survived, and so they're consensual, and it's still accepted that they should be rewarded. Now, if you look at enhanced factors, you don't have the same kind of diligence on the enhanced factors. I mean, anyone can come up with a proprietary backtest. There's no reason why hundreds of researchers would suddenly scrutinize this backtest. They probably don't have enough information even to replicate the results because they're proprietary. And so there's really no reason to think that these enhanced factors have the same level of scrutiny. If you look also at the empirical tests that are conducted for the consensual factors versus enhanced factors, you see a key difference. So all of these consensual factors are based on very long-term data. They've been validated across different samples. As we've seen, there's post-publication tests. So in contrast to that, lots of the enhanced definitions are based on basically a single test, quite often done by a particular provider, over something like maybe 10 years, 15 years in a single sample. So that doesn't carry the same amount of reliability as the consensual academic factors. And of course, another point is that there are formal explanations for the key consensual factors in academic research. For enhanced factors, there are rarely any formal explanations. I mean, maybe providers come up with some storytelling of why a certain tweak should somehow deliver results, but storytelling is not formal economic explanation. Okay. And so these are just the risks of factor fishing. So the risk in the end is a data mining risk. It's a data mining risk, and this risk is well documented. So if you look at the academic literature, there are papers, for example, by Campbell Harvey, where he documents this problem. So just backtesting, for example, different definitions, you're not actually able to conclude reliability with the usual statistical tools on actually the significance of these results, because you allowed yourself to test so many different variations. So I'll just show you a simple illustration to just illustrate this point. Again, this is not an extensive analysis, but it just shows a point that has been made more generally, which is, well, it's actually dangerous to tweak these factors because you're taking a lot of data mining risks. So what we did is we just looked at the value variable definition, and we said, hey, we can try to do better than book to market. Mm-hmm. We just look at results in a backtest, and we choose whatever variable does better. So we just tested 10 different variables. So we looked at things like sales to price, dividend yield, and other variables. And we also adjusted them to be sector relative. And we also tested the unadjusted version. So that leads to 10 variations. And what we're interested in is really what is the out-of-sample performance. So we can select the winner in a backtest, and then let's look at what that means outside the backtest. Mm-hmm. And you have the results on this slide. So basically, this is in the backtest. So we test different backtests at different points in time, and so this just shows you the average across the different points in time. So this is an event study type of methodology. So we can see that relative to book to market, you can increase returns by 180 basis points in the backtest. This is on average across the different periods. Now that's fine. That just shows that you can create an enhanced value index, if you will, that is truly going to be enhanced in the backtest. In any case, you're choosing with hindsight. The question is really, well, this kind of enhancement, is it also going to last going forward outside the backtest? And so we also looked at these same strategies out of sample. You have the result here. What you can see is that over the period following the backtest, these strategies actually, on average, underperformed by about 270 basis points relative to the simple book-to-market definition. So what you can see from this simple illustration is that you have a risk of getting overstated backtests. Okay, so by looking back with hindsight into your backtest and picking ex post the best variable, you're going to enhance performance in the backtest. But actually going forward, there's no reason why that enhancement should last. And so the real problem is actually overstating the result in the backtest.
Okay. Great. Well, now moving on to a different topic is the question of purity. Now, a lot of popular factor indices are not purely exposed to a given factor, and this is often a point of criticism. So is it true that more purity is not really important when in index creation?
Yeah, well, again, I think this is a result or an argument that is mainly based on intuition. So if you think about purity, okay, you have to isolate the exposure to this factor in a very pure way that, somehow sounds sensible. Purity sounds like a positive attribute. But again, if you look at, the empirical asset pricing literature, you will find that purity is not seen as any kind of requirement or any important property of a factor. So in fact, if you look at the empirical asset pricing factors, the ones that we've been talking about, so again, they're the consensual ones. They have survived, extensive scrutiny, and they are the result of, the consensual evidence on hundreds of studies, and none of these factors are pure. The standard momentum factor, the standard value factor, all of these factors are not pure. And in all of the studies, it's typically documented that they're not pure. So you do have kind of positive or negative correlations across factors. They're not uncorrelated. And this is not seen as a problem in these studies. It's actually, in a very transparent way, it's documented in these studies. Even if you look at studies that introduce new factors, so if you look at, for example, the initial studies after Farmer and French have come up with the factor model that includes value and size in addition to the market. So other studies have come up with additional factors, and kind of in the process of this analysis, they typically show the relation with these existing factors, because the objective is basically to see whether they have anything to add on top of these factors. And in that process, these factors are adjusted for the exposures to these already existing factors, and typically they are somewhat exposed. So it's very obvious from these studies that these factors are not pure. They are somewhat correlated, and there's no reason why that should be a problem. Purity is also not even a reasonable objective, because it may actually lead to other drawbacks. Okay, so if you actually aim at purity, first of all, there's no clear reason why purity would be necessary. But secondly, it leads to drawbacks. So there's probably less discussion on this issue, because simply most studies don't really deal with purity, but some of them do. They look at purity, and what is documented is that purity, if you try to achieve purity, this actually leads to other problems. And in particular, you end up foregoing diversification. So Farmer and French, in a recent paper, they try to isolate exposure to a given factor and control exposure to other factors. And they basically say that if you do that, we would quickly sacrifice portfolio diversification. And that's why they reject, in the end, in this paper, actually using these types of factors. A more practical consideration, but which kind of goes the same way, is about other implementation challenges. Okay, so you forego diversification, but actually you also forego implementability. Okay, so if you're trying to target pure factors, you will face severe implementation issues. And this has been very well documented by major index providers, because if you look at the offerings of major index providers, they actually had many offerings of indices aiming at purity that typically they have discontinued. So many of these offerings have been discontinued because of implementation issues. And so this again just provides some insights that, well, maybe purity somehow sounds favorable, but in the end it's not a real issue. And the problem is, well, if purity is not a real issue and you're trying to implement it nevertheless, well, in the end, not only are you concerned with improving something that isn't a real benefit, but in addition, you're actually going to give up on diversification. You're going to give up on implementability. And so in the end, being kind of misguided in seeking purity may actually lead to quite severe shortcomings on these much more important dimensions.
Okay. So the case for purity is often overstated, and in seeking it, you might actually lose out on diversification and implementation. Now, to another similar issue, which also sounds intuitively attractive, what about concentration? There are many who argue that investors should seek strong exposure to a given factor, but why is this problematic as well?
Yeah, so this is exactly another one of these arguments. So it sounds good to have strong exposure if you're trying to be exposed to a factor. And to discuss this, I'd just like to go back to the starting point, really, of getting these factor tilts. So why do actually people try to get factor tilts? Well, it's simply because it has been documented that tilting to these factors actually leads to a reward in terms of higher expected returns for these factors. Okay, so these are these so-called priced factors. They will deliver a reward. Now, if you're trying to seek high concentration in certain types of stocks with the right factor characteristics, that really doesn't have anything to do with the evidence on priced factors, because if you're trying to tilt towards very few stocks with certain kind of characteristics that you want, this is really an exercise of stock picking, right? So it's not an exercise of factor investing, it's an exercise of stock picking. If you look at the evidence on factors, well, the key insight is that these factors lead to a reward in terms of higher expected returns. Now, what do we know about higher expected returns? Well, we know that higher expected returns are extremely difficult to estimate at the individual stock level. Okay, so there's a very well-known paper by Fisher-Black in 93 where he basically makes this argument. He says, well, you shouldn't actually try to take into account very fine-grained differences across individual stocks, because you're going to end up basically acting on noise. So instead, what he advocates is the so-called portfolio method. Okay, so you should form portfolios, very broadly diversified portfolios, that then may tilt to a given factor, and that way you can actually capture in a much more reliable way the differences in expected returns, because differences in expected returns may be reliable across groups of stocks. They will never be reliable when you're trying to figure out differences across individual stocks. A more theoretical argument also is that if you are actually constructing portfolios that take into account these factors, the objective basically in portfolio construction is to construct portfolios that are risk-return efficient for a given level of factor exposure. So there's a kind of a summary paper by Cochrane in 99 where he basically looks at, well, what are the implications of the existence of these factors for actually portfolio advice, for actual investment advice. And basically what he basically summarizes is that when these factors exist, you should target at risk-return efficient portfolios at a given level of factor exposure. And that basically means you cannot just forget about risk and managing risk through diversification, but you actually have to construct efficient portfolios. There's really no reason why it would be desirable to construct heavily tilted or strongly tilted portfolios to a given factor. So that approach of concentration, that would only be a reasonable approach if you were very confident that there's a deterministic link with expected returns at the stock level. And the data is just not reliable enough to figure out this kind of deterministic link. We have links between factors and broad groups of stocks, but we cannot reliably identify expected returns at the individual stock level.
Okay. And now beyond this discussion in literature that you brought up, have you conducted your own studies on concentrated versus diversified indices?
Yeah, so we conducted a study actually where we test kind of stylized examples of concentrated factor-tilted portfolios and more diversified factor-tilted portfolios. And we're just showing the results here. So let me just explain what we did. It's really a straightforward setup. So we basically used a stock selection to tilt to a factor. We did this across 6 different factors. The results here are just the average results across all the factors we tested, just to summarize what we got. And so we're looking at a 50% stock selection, very broad. We select half the stocks in the universe by their factor tilt. And then we also look at a 20% stock selection, where we select only 20% of the stocks. So these selections contain much less stocks with higher exposure, of course, to the factor. Then we applied 2 different weighting schemes to these stock selection. Cap weighting. So cap weighting will lead to fairly high concentration, because of the distribution of firm size. And we also applied equal weighting. So equal weighting is like a very simple, naive form of designing a diversified portfolio for any given tilt. The results are quite interesting. So if you look at the impact of the stock selection, for example, and you can stay with equal weighting, for example. So select 50% of the stocks by the factor tilt and apply equal weighting. Well, you get a Sharpe ratio of 0.66. That's an improvement over the broad cap weighted index as expected. But what happens now if you reduce the stock selection to only 20% of the stocks? So you're going to be more strongly exposed. Well, the result is the Sharpe ratio is 0.67, so it's virtually identical. And you can see that basically what happens is that the average returns go up by reducing the stock selection, but also the risk also goes up, so volatility also goes up, and that's obviously expected. And what this shows is that there's really no benefit to actually being more concentrated and narrowing the stock selection. On the other hand, what you can see is that if you use this equal weighting approach as opposed to cap weighting, you can see that at any given level of stock selection, that actually adds value, which again suggests that diversification may be a more important issue than strong factor exposure. Now, another interesting result here is the investability of these portfolios. So what you can see is that the turnover of these strategies increases dramatically when you become more concentrated. So we discussed that narrowing the stock selection doesn't add anything in terms of risk-adjusted returns, in terms of Sharpe ratio. Well, actually, it increases dramatically the turnover. So if you look at the turnover levels, they are in the area of 30%. For the broader stock selection, they increase to almost 50%. Mm-hmm. So what this suggests is, in the end, by becoming more concentrated, you're not improving performance, but you're actually making the portfolios less investable. It's more difficult to invest in them.
Okay. Great. Well, we're running out of a bit of time. So before we go on to taking questions, can you just summarize what the main implications are for investors of all the misconceptions that we've discussed so far?
Yeah. So what is the key point for investors? Well, it's really that if you rely on these misconceptions, it may actually lead to important risks in potential adoption of smart beta strategies. And I mean, I'll just illustrate that with a few examples. So we discussed this idea, this so-called monkey portfolio idea, so all strategies are identical. Well, saying that all strategies are identical, that basically greatly simplifies kind of the due diligence that you have to make, right? If they're all identical, they lead to outperformance. You don't really have to try to understand the methodology in detail. You can actually just stay with whatever is the most well-known or whatever is the most simple to explain to stakeholders. You don't have to analyze in detail the differences across methodologies because they don't matter. And that's obviously a kind of very misleading finding because investors should take care to conduct this kind of due diligence and understand in detail what is the investment philosophy. Likewise, if you're very concerned about crowding, for example, one kind of suggestion that especially proponents of this crowding argument make is, well, since these common factors are probably going to be crowded, you should stick with kind of very proprietary factors because these are factors that people don't really know about, and so there will be no crowding in these factors. Well, if you actually rely on these very proprietary factors, you're probably going to take a lot of data mining risk, right? Because you're not relying on the consensual evidence of well-known factors, but you're actually coming up with using exotic factors, and very likely you're going to have a lot of data mining risk. You're not going to have the same reliability as with the well-documented factors. And finally, as we discussed, if you're very concerned about things like strength of the tilt, purity of the tilt, you're also likely to actually not pay enough attention to first-order problems, which are a good degree of diversification, investability, and so these misconceptions really actually may lead to serious risks.
Okay, and how do we avoid these misconceptions then?
Well, I think there's a few kind of very simple ways, and essentially what is important is really to consider the broad academic evidence. So, quite often you see that these misconceptions actually arise because, they rely on intuition more than facts. Okay, so you can make kind of intuitive statements. We discuss things like purity, for example, or strength. I mean, it sounds like intuitively that would be a good thing. But really what's important is to also analyze the facts, and intuition is typically not a good guide. We should also look at the facts, and the facts should be much more important than some kind of intuition or some kind of storytelling on some of these topics. And another, I think, very important issue is really that it's quite limited to rely on results in kind of a single paper. So it happens actually quite often to me that investors will ask me about a certain recent paper by some provider that they have read and say, well, actually, what's your view on this paper? And typically my answer is that, well, I don't really think much about it. I think that there's so many papers in high-quality peer-reviewed academic journals, and it's very important to consider what these papers actually find and what's kind of the broad consensus is. A single paper may or may not be reliable. It's something that I wouldn't draw too many conclusions from just looking at a single paper. And so I think what's really important is, not give too much attention for some very idiosyncratic results, and instead rely on kind of the broad evidence, across many different studies that has been kind of vetted and replicated and confirmed independently.
Okay, great. Thanks, Felix. Well, now we're going to be taking some questions, and Felix, if you could help us perhaps address some of these questions from our audience members. So let's have a look. So, okay, here's one which relates to the monkey argument, which you just brought up. So the question is, do you not misrepresent the monkey argument? The monkey argument is more about saying that a monkey portfolio beats cap weighting, not about saying that smart beta strategies are the same as monkey portfolios. Okay, so do you represent the monkey argument? Misrepresent the monkey argument, sorry.
Yes, well, I mean, what we did is basically we took this upside down methodology, which was published in kind of a paper making this monkey argument, and this was kind of precisely the claim that was made, and we just kind of tested the claim, and we showed that it doesn't hold. So I mean, and we document this very carefully in our paper, that we kind of directly look at the kind of claims that have been made in the paper. So we published this paper, Smart Beta is Not Monkey Business, and you will find citations to kind of all the claims that have been made, and we basically empirically assess these claims. We document that quite carefully. Now, to be sure, I mean, there are some papers that also look at this monkey idea in a different way. So you can just create random portfolios, and there are kind of some papers that just look at these randomly generated portfolios, or so-called monkey portfolios, and show that they outperform cap-weighted indices, and then alongside these strategies, they also analyze smart beta strategies, and then they conclude that, well, the monkey portfolios outperform cap-weighted indices. The smart beta strategies also outperform cap-weighted indices. They don't necessarily explicitly make a clear link between the two. But in that case, I would really prefer that there's kind of a clear, explicit statement that there is actually no link, and these are just two things that are being analyzed more or less separately in the same paper. And so I think you could maybe be more explicit about that. But it's true that some papers basically look at random variations around equal weighting and show that beats cap-weighted indices, and that doesn't obviously say that the existing strategies are necessarily of the same type, but the precise claims that we tested, they make exactly this claim.
Okay, great. Okay, next question. Let's see. Here's one. It says you mentioned risk-based explanations for factors, but clearly the low risk factor or the low beta factor does not lead to taking on more risk. So shouldn't these factors at least disappear? Okay, so we're talking about the low risk and the low beta factors. They don't lead to taking on more risk. Should they disappear?
Yes. Okay. So I mean, this is a good question. It's kind of a common discussion. Mm-hmm. So basically, you have risk-based explanations for all of the factors that we discussed. So we discussed these 6 factors, mm-hmm. and that actually includes the so-called low risk or low beta factor. Now, for some of the factors, this seems quite intuitive. Okay, so typically we're quite willing to accept that, for example, a size tilt or a value tilt may lead to taking on additional types of risk. But when actually the tilt is precisely about, tilting to the low volatility or the low beta stocks, well, beta or volatility are a measure of risk. So how can you say that this is explained by more risk? Well, the answer to this is it is explained by additional types of risk. Okay, so yes, obviously low beta stocks have a low market beta. That's by definition the case. But they may bring in other types of risk. And in particular, what has been documented is that you have an exposure to funding liquidity risk. Okay, so it has been documented that low beta stocks, basically they may be employed by investors who will then use leverage. So they will use low beta stocks, and they will use actually leverage to obtain a higher exposure to market risk. And what happens then is that if funding liquidity dries up and if it becomes more difficult to actually sustain that leverage, then actually they may be actually forced to sell these stocks, and you can actually see that this factor is exposed to funding liquidity shocks. And so it has this additional type of risk. So yes, by definition, these stocks have lower volatility, they have lower beta, but they have additional types of risk. And by the way, this is quite often the case with other factors. So you sometimes see claims, which I think are kind of rather loose claims, saying that, well, look, the value stocks or some other kind of tilted portfolio doesn't actually have higher volatility, doesn't have higher market beta than the broad cap weighted index. So clearly, how can people still claim that these are risk premia, right? That they don't have more risk? Well, the question is, what is risk? So the relevant risk is basically this idea of poor returns in bad times. So in bad times when marginal utility is high, If assets have low returns in these bad times, well, then investors basically require a risk premium.
Okay. I think we have time for one more question. So let's see, it's a question from Chris. He says, we have reviewed some of your back-tested returns, such as your new emerging market product, but how can I tell when backtesting is really just fiddling with the data to derive the best results? So he's asking about data fiddling and backtesting.
No, yeah, this again, and this I think is a very relevant question. So obviously, all of these smart beta strategies, they are, kind of marketed and analyzed based on backtests. And so you have to be kind of very aware of the risk associated with these backtests, and we kind of discussed some aspects of that. And this is basically a data mining issue, so you can just come up with something that works in the backtest. So if you see a strategy that is based on a backtest and the performance looks great, should you really take that seriously, or should you just think that it's maybe people have fiddled with the data, as you say? Well, I think there's a couple of kind of maybe red flags or kind of identifiers that should lead you to be maybe suspicious. And so what are the kind of things to look out for? I think one of the issues clearly is, as we mentioned, is what are the factor definitions. So if a backtest delivers performance by tilting towards consensual factors, well, there's really no possible data mining. I mean, these factors have been not just confirmed in this particular sample, they hold, across many different samples, they explain economically. So if people design a strategy tilting towards these consensual factors, they're not a result of data mining, they're just a result of, considering this thorough academic evidence. As we've seen with these exotic factors, proprietary factors, we need to be a lot more careful. And obviously, since there's an infinite number of variations of tweaks, obviously the result has a high data mining risk. Another important issue, I think, is really the consistency of the methodology. So if a methodology is consistent, so if we apply the same methodology to all of the factors, for example, and the same methodology across markets, well, there's actually practically no room for, as you say, fiddling with the data, right? Because we're just applying the same methodology. And so consistency of the methodology is really a key point. And so if you see that certain types of smart beta products, they will use one methodology to tilt to momentum, and then they will use a completely different methodology to tilt to value, then of course you should be suspicious that there may be some data mining risk or a high degree of data mining risk involved. Also, if the indices are not consistent over time, okay, this is another red flag. So if providers come up with new indices and say that, well, look, we had a value index or a momentum index, but now we're going to give you the new version of the value index or the momentum index. Well, obviously, there's a lot of flexibility to do a lot of data mining if you change the methodology every 2 or 3 years. And so if there's consistency over time, that methodology is stable, that's again something that is more reassuring. Also, you mentioned specifically emerging markets, and you're referring to the sine beta indices for emerging markets. Well, again, if you use a methodology that has been applied for years to developed markets, and then you apply that same methodology to emerging markets, I mean, in practical terms, you cannot do any data mining because you're just using the exact same methodology. So you refer to the sine beta emerging market index. So that index has been launched very recently. It has the same methodology in terms of if you think about the smart factor indices. This methodology has been live in developed markets for about 4 years, and it has just now been applied in a very consistent manner to other markets. So there is actually no room for data mining now because it's just the same methodology. So again, you do certainly find occasions in practice where a provider will have different factor definitions across markets, or will even sometimes in multi-factor indices, for example, favor different factors for different markets. And that again is clearly a warning sign that you may be taking a lot of data mining risk. So I think really the key issue is the kind of consistency of the methodology.
Okay. So to answer that, it's important to look at consensual factor definitions, consistent methodology being applied, and to look out for inconsistency in index definitions or across different markets. Great. Well, I think that's all the time we have for today. So Felix, thanks once again for being here with us and sharing your insights. And to our viewers, if we were not able to answer your questions now, we will be sure to respond to you by email. And if you do have further questions, please do send them to us at webinar@scientificbeta.com, and we will get back to you in due course. So we hope you have found this informative. As pointed out today, many of the misconceptions we have discussed are overgeneralizations, which fail to acknowledge that the term smart beta covers a vast variety of strategies with potentially very different properties. So in short, we should be careful not to oversimplify, and it's important to look at smart beta claims and criticisms while taking into account the empirical evidence behind certain statements. So for those of you interested in further reading, we are soon publishing a paper on this topic, which is called 10 Misconceptions About Smart Beta. It will be available on our website. We're going to send you the link to access it, along with the link to replay this webinar and to download the slides in this presentation. So, and lastly, if you do not already do so, please follow us on social media. We are on LinkedIn, and our Twitter handle is @scientificbeta. Thank you very much for watching, and goodbye.